as we were discussing, you think about the figures that we got this morning on the headline, on the core, coming in pretty much as expected here. But how does this change the needle, move the needle, if at all, when it comes to the debate over what the Federal Reserve is going to do when it comes to its interest rate trajectory and what we hear from Kevin Warsh, the new Fed chair, in about 7 days' time?
So for the committee overall, I'm not sure it changes anybody's mind as far as something to do immediately. So I still don't expect any action at the next meeting, but it's disturbing. And, you know, the economists can parse inflation readings and talk about this and trim mean and all of the different measurements of inflation and what's going. But for everyday consumers, that doesn't matter. The things you have to buy are getting more and more expensive. And now for the last 2 months, the expenses are outweighing paychecks. And that's where the real danger is.
Yeah, and I want to continue down that path because, again, you think about what we saw on headline inflation. It was really driven by higher gasoline and energy prices. Of course, you wouldn't see that in core, but you make the good point that it still affects human psychology when you're paying more for those higher energy prices. How does that typically translate through into how consumers spend their money? Because sentiment has been pretty low for a while here, but we haven't necessarily seen that direct line yet.
So it's not just how they spend their money. A lot of the issues come with what do they do in terms of expectations? What demands do they make in terms of wages? So the most important thing to control inflation is the credibility that the Fed can control inflation, or credibility that the government can somehow control inflation. And once that credibility is lost, then everyday consumers are just scrambling to make enough money to be able to pay for things that they're quite certain are going to cost more and more and more in the future.
This raises the question, and it might be a dumb question. I think I know the answer, but who is Kevin Warsh speaking to when he takes that podium? I mean, is it the markets, which I presume it probably is, or is it those everyday consumers that you're kind of referencing? Because there is a disconnect here that the markets are looking at today's report, and they're seeing a lot of upside potentially for what would lead to rate cuts. But then again, the anecdotal evidence on the ground, when you talk about falling saving rates, rising debt levels, collapsing consumer confidence, shows that people on the ground are struggling.
Well, when the chairman takes the podium, he's speaking to markets, to investors, to consumers, to the public at large. But for Kevin, this is going to be his very first statement to all of those publics. And so I would look for him to sort of set the stage for how he thinks in the future. And I don't think you will see it as specific as, you know, this is how I would react to that, and a very specific reaction function. But I think overall, Kevin is going to remain a hawk. Kevin's going to be concerned about inflation, concerned about getting inflation under control, but he's going to tackle it perhaps in a different way than previous chairmen have.
When we talk about the report that we got today, and particularly some of the disinflationary components that we saw today, I think it was cars, household furnishings, it seems like some of the interpretation, at least by Bloomberg economists, is this idea that that is a reflection that the consumer is pulling back on that rather than this being some sort of structural shift down in those prices.
Well, I think we've had so many one-off issues. So you go all the way back. There were the supply shocks of the economy reopening after COVID. Then you had tariffs. Then you had the war. You had gas prices. And it's very hard to know how all of these are feeding through. But it's very important that prices have now been below the Fed's target for 5 years, possibly even more by now. When I was at the Fed for 5 years, and in that time, we could never get inflation up above 1%. So you have to begin to question whether the Fed has the will to control inflation or the ability.
Yeah, the ability is certainly an urgent question here. And, you know, I was reading some reaction from our colleagues over at Bloomberg Economics, and they do think that there could be this sort of self-correcting mechanism when it comes to inflation, sort of what we were talking about with, you know, consumer psychology, that, you know, if we see the cost of living rise to a certain point, that's going to bring down discretionary spending in other parts of the economy, and eventually lower prices. And, you know, I wonder if that's a theory that you agree with, and, you know, how much water you would put in it at this moment.
So there is some truth to that. The part I'm not sure of is when you get this K-shaped economy, or the difference between consumers who are struggling day to day and particularly investors who have seen tremendous gains in the market. And so they're the ones doing most of the spending now. So how does their spending adjust versus those who can barely pay for the things that are non-discretionary?
When we talk about, I guess, how you right this ship, there has been some discussion that a monetary policy alone, or at least the interest rate function of monetary policy alone, won't be enough to really turn that tide. How much power does a shift in interest rates, either up or down at this stage, actually have?
I'm not sure it's going to have a big difference, whether it goes a quarter point up or a quarter point down. I'm not sure that's going to make a big difference, which is why I think the Fed is perfectly right to hold steady until they begin to see, are some of these issues going to play themselves out and begin to return to the norm, or is there something that's running away from them? So I think waiting until they establish a direction is really the thing to do.
And it seems like in the markets, what's being priced in outside of what we're seeing in AI, of course, that's its own special situation, is a quick end to the conflict, some sort of resolution that's tangibly in the offing. That's explained what we're seeing when it comes to breadth in the equity market, what we're seeing, the sort of non-reaction that we've seen in the energy markets. But Betsy, I do wonder, how much damage has been done when you think about what we've been seeing in the rising prices of energy, of foods, grocery bills, et cetera. I mean, even if we saw an end to the conflict in somewhat short order, a reasonable manner, I mean, how much of what we're talking about, these inflationary pressures, are becoming entrenched here?
Well, I think if you saw an end to the conflict, you would definitely see some reduction in inflation. Certainly, fuel prices would come down, and any way that they're feeding through to other inflation would begin to come down. So I think that's the case. The other issue at play that I'm not sure of is the size of our federal debt. The other news that didn't get a lot of play today is the fact that Social Security is going to run out of money a little bit before than they originally thought. So senators running for the Senate right now will have to deal with this issue of what to do about Social Security in their 6-year term. That's a very short window, and the higher the debt gets, the more that's going to push rates up, regardless of what the Fed does.